Welcome to another Blueprint to Escape case study.
Today, our mission is really focused. We're putting together a guide for income investors.
Right. Specifically for folks in Canada and the US, looking at three core sectors that we see as the foundation for a really solid portfolio, especially heading into 2026.
And that structure, that framework, is just everything. The idea is for you, the listener, to leave with more than just a few ticker symbols.
Yeah, you need to get the why.
Exactly. The why behind these choices,
Yeah.
how they're set up to deliver strong, steady income, and also give you that long-term stability when the markets inevitably get a bit crazy.
Okay, let's get into it. We're going to be talking about specific sectors, specific ETFs, and this is all based on our own research, expert knowledge, and public stats from 2025. But first things first.
The mandatory part. Just remember, all of this is for informational and educational purposes. It is not financial, tax, or investment advice.
You absolutely have to talk to a qualified advisor for your own situation.
And any companies or ETFs we mention, names like Evolve or Harvest, they aren't sponsors. We're just analyzing the data and the strategies they're using.
Perfect. Okay, with that out of the way, let's dive into the absolute cornerstone of this whole portfolio structure, Canadian banks and financials. For a lot of income investors, especially in Canada, this is a familiar place. It's a huge, consistently rewarding source of income and, I guess, stability.
It is. But what's really insightful here is the unique structural advantage that Canadian banks have. It's what makes them such great core investments, particularly when you compare them to banks, say, in the U.S. or globally.
That's a point I hear a lot, but it's rarely, broken down. We just hear, oh, Canadian banks are stable. But why? What's the real difference between them and a giant like a JP Morgan?
It really comes down to two things: regulation and market saturation. In Canada, you have what's essentially a concentrated banking system, the Big Six.
An oligopoly, basically.
Exactly. And it's very heavily regulated by the government.
Yeah.
They have to operate with much stricter capital reserve requirements, and they're far less exposed to the kind of aggressive speculative trading that, caused so much trouble 15, 20 years ago.
So it's not an accident. The stability is actually baked into the system by design.
It is. They're just less likely to get caught up in global crises because their main business is pretty conservative. It's traditional lending, mortgages, wealth management, all inside a protected market. For an income investor, that consistency is gold.
That makes a lot of sense for a foundation. So to make this actionable, we're spotlighting the Evolve Canadian Banks and Lifeco's Enhanced Yield Index Fund, ticker bank.
Right. And what's smart about this fund's composition is that it's not just the 6 big banks.
It's more than that.
Yeah, it includes these other major financial institutions with huge international footprints.
Yeah.
The Lifecos like Manulife, Great-West, Sun Life.
So the big insurance and retirement companies.
Right. For Canadians, these are household names. They handle pensions, insurance. So by blending them with the banks, you get exposure to the entire financial backbone of the country. It's a nice hedge.
And this is where the strategy gets a bit more aggressive. It's built to really squeeze income out of that stable base.
It is. They use an active covered call strategy on up to 33% of the portfolio.
Yeah, so about a third of it.
A third, yep. And then they add up to 25% maximum leverage. It's a very deliberate design.
And the performance.
The performance really tells the story. Over the last year, bank had a total return, and that's price increase plus the yield, of 39%.
39% on
Okay.
Canadian banks. That's huge.
It is. And it provides a very consistent distribution yield that's historically been in the 13 to 15% range.
We have to stress, though, when you see a yield number like that, it's not a guarantee, right?
Oh, absolutely not. Yield is a dynamic number. It's a formula, right? The distribution amount divided by the current market price of the ETF.
So if the price shoots up, the yield percentage actually goes down, even if the payout is the same.
Exactly. And the reverse is also true. That's why the total return, that 39% figure, that's the number that tells you the real story of what an investor actually made.
And looking at the holdings, it's exactly what you'd expect. TD Bank, Royal Bank, Great-West Lifeco, Manulife. Okay, so that's the core income foundation locked in.
Right. So you've got stability. Now, where do you find the growth engine to balance it out?
That is a perfect transition to our second pillar, U.S. technology. I like to frame this for people as, well, the new utilities. We think of water and electricity as essentials, but is that analogy really holding up?
It's holding up incredibly well. The shift has already happened. Technology isn't a luxury anymore. It's basic infrastructure.
Yeah.
AI, cybersecurity, cloud services. These are the pipes and wires of the modern economy.
And when you're looking for innovation and scale in that world, The U.S. is. It's the only game in town, really.
It is. Hands down, the numbers are staggering. Large-cap U.S. tech companies drove more than half of all global market growth between 2015 and 2022. You have to have exposure to that.
So the question then is, how do you get that exposure without just, piling into the Magnificent Seven and taking on all that concentration risk?
And that leads us to the core tech engine we like.
Yeah.
The Hardest Tech Achievers Growth in Income ETF, or HTA.
HTA. Okay, what's the philosophy here?
The philosophy is structurally defensive. It holds an equally weighted portfolio of 20 large-cap tech companies.
Equally weighted, so that's the key.
That's the key risk management piece. It means if one of those big names has a bad quarter, it doesn't sink the entire fund. It spreads the risk out across the whole sector.
And the goal here is both growth and income. It's currently yielding around 9%.
And just like the bank ETF, it gets that enhanced income from an active covered call strategy. It's designed specifically to generate that high monthly payout, boost income, and maybe most importantly for tech, lower the overall volatility.
Okay, so if the covered calls are lowering the volatility and giving you this great cash flow, what's the catch? What's the trade-off an investor needs to understand if, say, one of those stocks just goes to the moon?
That's the crucial question. The trade-off is capped upside. When you sell a covered call, you're selling someone the right to buy your stock at a set price.
The strike price.
The strike price. So if a stock like NVIDIA just explodes higher on some breakthrough news, the fund might have to sell its shares at that lower agreed-upon price. It gives up some of that massive gain.
So you're trading a piece of that potential explosive growth for a more reliable, enhanced monthly income and a smoother ride.
For an income-focused investor, that's a pretty good trade. The fund is built to soften the blows during market dips while consistently paying you.
And the holdings show that diversification. You've got Micron, Applied Materials, Accenture, Alphabet, Apple, Texas Instruments. It's a really wide net.
Now, for investors with let's say, a higher risk tolerance, there is a multiplier available.
You're talking about HTE.
HTAE, right. It's a 25% leveraged version of HTA.
So it's a more aggressive style.
Much more aggressive. It acts as a multiplier on that core HTA engine. It has the same 20 stocks, same covered call strategy, but by applying that modest leverage, it's built to deliver even higher monthly cash flow and magnified growth.
We've now laid out these two powerful pillars, banks and tech. And we've seen they both use the same two mechanical levers, covered calls and modest leverage. Let's really dig into those tools for a minute.
Yeah, let's connect bank and HTA here. The covered call strategy, like we said, enhances the payout by generating extra income from selling those call options. That gives you a stable income stream, even if the market is just moving sideways.
It's an active strategy for cash flow, exactly what an income portfolio needs.
Exactly. And it also, by its nature, helps lower the portfolio's volatility. It's a hedge. But let's be blunt about the trade-off. The price for that stability and high yield is that capped upside we talked about. You have to be okay with that.
Okay, now let's talk about the multiplier. Modest leverage. Both bank and HTAD use it, capped at 25%. This is what can make some investors nervous. What is it really doing?
Modest leverage just means the fund borrows a small amount of money against its assets to buy more of the stocks it already holds.
So it's a multiplier.
It's designed to be a multiplier for returns, yes. It enhances the monthly cash flow, and it magnifies the returns from the stocks and the covered calls.
And that's exactly what powered that 39% total return we saw in bank.
It is. But, and this is a big phase, but leverage is a double-edged sword. It magnifies gains, but it also magnifies losses if the market turns against you.
So what's the mitigation here?
The risk is managed because these funds are focused on stable large-cap sectors, banks, big tech, and they use that income from covered calls as a kind of buffer. But any investor using leverage has to understand that the potential for loss is also amplified.
That makes the structure crystal clear. Now, for our final and maybe most important sector for diversification, especially for investors over 40 who have built up some capital, business development companies, BDCs?
BDCs are absolutely critical. We call them the portfolio super hedge. You need something in there that moves to a completely different economic beat than big tech.
And why the specific focus on investors over 40?
It's about capital preservation and needing income that's not correlated to the stock market. Once you've built up a sizable nest egg, you need reliable income that isn't just tied to the boom and bust of equities. BDCs pay you from private credit, from interest payments.
Okay, so what exactly is a BDC?
A BDC is basically a way for you to invest in the private credit market. Think of it like a venture capital firm, but one that's focused on making loans instead of buying equity.
So they're lending money to small and medium-sized businesses.
Growing middle market businesses across all sorts of sectors. And here's the critical part. By law, they have to distribute at least 90% of the interest they collect from those loans back to their shareholders as dividends.
Ah, so their income source is totally different. It's based on the health of private debt and interest rates, not on consumer mortgages or scaling a tech platform.
Precisely. And that's the hedge. BDCs can actually do well when interest rates are stable or rising because they can charge more on their loans. Growth tech, on the other hand, can suffer in high-rate environments. It's a true counterweight.
So you're balancing the volatility of tech with this high-yield income stream, often, 12 to 15%? That's coming from a completely different part of the economy.
That is powerful diversification. I really think having a real allocation here, maybe 10 to 20% of the portfolio, is essential to have that hedge in place.
Now, anyone who starts researching BDC ETFs is going to hit a big, scary-looking wall, the fees. Specifically, acquired fund fees and expenses, or AFFEs.
This is such a critical point, and it scares so many people away for no reason. You look at an ETF, like the Putnam BDC Income ETF, BDC in the US, and you'll see a disclosed expense ratio that looks insane, like over 10%.
Yeah, that would make anyone run for the hills. It looks like the fund is just eating all your returns.
It's completely misleading, and it's just an accounting rule. The underlying BDC companies that the ETF holds, they have their own operating fees. The ETF is legally required to report those fees as if they are its own.
So it's not an extra layer of fees?
No, it is not an extra layer of fees that you, the ETF investor, are paying. Those costs are already baked into the price and performance of the BDC stock itself. Understanding that is the key to unlocking this whole sector.
That is a vital clarification. So for implementation, PBDC is the U.S. option. What about for Canadian listeners?
For Canada, there's the Accelerate Diversified Credit Income Fund, ticker INCM. Both are actively managed and let you get that crucial hedge without having to pick and choose individual BDCs.
But for the more hands-on investor, there are individual BDC stocks.
Oh, absolutely. We often highlight companies like Hercules Capital, HTGC, or Trinity Capital. They're more concentrated bets for sure, but they give you that same direct exposure to high-yield private credit.
So we've tied these three pillars together, Canadian banks, U.S. tech, and BDCs. What is the single biggest lesson for the listener here?
The most important lesson is not to just go out and blindly copy these tickers. I mean, that would miss the entire point of this case study.
The real value is in two things. First, the asset allocation and the structure. How are you balancing growth, stability, and these different economic risks to match your own goals?
And second, do you actually understand the dynamics of each sector? Do you like or even use the underlying businesses? We feel good about this structure because it's built on, essential enduring services and stable assets.
The final provocative thought here is that when you integrate these leveraged, covered call growth sectors, tech and banks with the high-yield private credit BDCs, you get a really resilient framework.
It's a structure that hedges completely different economic risk factors against each other. Growth versus interest rates. That's the blueprint for stability.
If you're serious about generating reliable income for financial independence or, planning an early retirement, we really hope this blueprint to escape case study has given you a lot to think about.
Please post your comments or any questions you have. We'd love to hear from you. And subscribe for more content on this whole world of financial independence, passive income, and nomadic life design.
Definitely hit like and subscribe. You won't want to miss our future breakdowns. And just so you know, we unveil our full portfolio once a month, usually around the 20th, so you can see exactly how these pieces all fit together.
And as always, do your own research. And please speak to a licensed financial professional. This is all for educational purposes. Thanks for joining us.